Venkatraman, Managing Director of IIFL, joins us live. Venkat, good morning and thank you for joining us. Venkat, 4 days into trade, or I would say 5 days into trade of 2014, there is no excitement, there is no euphoria, there is no volume, and there is hardly any buying.
Good morning, and first of all, I take this opportunity to wish you and your team and your viewers a very happy New Year. And as you said, as you correctly pointed out, New Year has started off on a rather tepid note. Having said that, I think we have to put things in perspective. The run-up to the New Year was quite, I would say, euphoric, and so the market is taking a kind of breather, and they're primarily because of two reasons. One is, of course, we are entering into the earnings season, and from starting early next week, all the Infosys will announce results, and that will kickstart the formal earnings season. And most of the market observers are waiting and watching and seeing what cues they can pick from the third quarter numbers to actually decide whether the worst is over or we are seeing some kind of recovery or stability in the earnings estimates of all the large companies. And the second, of course, is anywhere from 4 to 5 months from now, we will be having general elections, and so most of the people are waiting and watching to see what kind of government is formed in the center. And as of now, 5 months is a long time to predict anything in politics, especially in a country of 120 crores with a significant, with changing dynamics, moods, and all kind of things that happen on a rapidly changing environment. So that we think is the reason why the market is taking a breather, and generally, I would say it is in a wait and watch mode.
Venkat, hi, morning. In the near term, though, all eyes are going to be on Infi's earnings come Friday, in what is traditionally a weak quarter for most IT majors, as well as a muted constant currency growth as well expected across the sector this time around. What's the key that you're watching out for from the IT space, and what, according to you, would outperform and underperform in terms of earnings this time?
For the coming to the IT space, I think the big story of the re-rating was the rupee depreciation part of it, which we believe has more or less happened out. So now we will not get a gigantic or a big violent currency move in the short term. So, and the rupee depreciation story, I think, would gradually pan out. So simply because of the way the Indian economy is structured, although we are seeing significant improvements on the current account deficit front. Now the challenge for growth it will be company specific, how big and how they are able to scale up the order book. There are stories of the US recovery coming. Europe is still not in such a good shape. So now it will completely depend upon what kind of projections the management of all IT companies, not only Infosys, talk and give estimates. Coming specifically to Infosys, I think there will be more talk about the succession planning and the restructuring that seems to be happening. So the people will be looking to observe that. And thirdly, I think there is some amount of valuation mismatch between mid-cap space and the large cap space on the IT pack, and we have seen a very good rally in the large names. So some amount of portfolio reshuffling might take place on the mid-cap space also, and we will be seeing some amount of action shifting to the mid-cap part in the IT. But all in all, I think big numbers to be waited for is what projections they give for the full year and going forward for the next year based upon their own estimates of more deals happening from US and on the so-called big issue of succession planning.
Venkat, does it seem like all this macro data as well is making the market a little nervous, because that really throws upon, the question mark on what the RBI is going to do next?
See, coming specifically to the macroeconomic data which are coming out, and most of the observers are keeping an eye out on that. We feel that the worst is over, and when the worst is over, it does not mean that suddenly you will have a V-shaped or a dramatic recovery. So, for going on a point-to-point basis, incremental worsening of the numbers will not be seen. So, we are going through this phase of a quote-unquote a longish bottom. And of course, last time around, the RBI governor gave a pleasant surprise when interest rates were not hiked. Our guess is that even in the next credit policy or so, even if there is an increase, I think that will be we are getting into the fag end of the rate tightening cycle. And the overall for the next 12 months, I would say interest rates will take a breather and slowly and steadily start inching downwards. On the entire BFSI space, or the broader issue is whether we have seen the worst of the NPA cycle, and that is one number which seems to dominate analyst and fund manager discussions, because everybody says that there is still X amount of NPA or the credit losses which are still out in the system, and that has to be taken into account before we can actually think about a complete re-rating of the BFSI space. So our guess is we have to wait and watch for this quarter numbers, and somewhere between this quarter and maybe next quarter, we expect that the worst of the NPA worsening cycle would have gotten over. And just putting things in perspective, I think last time around in our times, 2001, 2, 3 were very bad years for all the banks, and if you remember, all the banks were available at throwaway prices, and there was a large amount of divestment took place, and from there, from 2003 to date, or maybe 2003 to 2008, this was one big leader for the bull market, and all the stocks did exceptionally well. Those are similar times when most of the people were talked about worsening credit cycle, need to capitalize banks, and the entire the public sector bank space was virtually written off. The point we are trying to make is, as and when the economy recovers, there is a general or a benefit on the NPA cycle, and companies tend to benefit from the improving macroeconomic cycle. And second thing is on the bond portfolio also, then there are gains, because as the interest rate start cycle start reversing. So we get this double advantage. So we have to wait and watch for the next 2 quarters before taking I would say such a big negative call.
So I fully understood the template you are working with. You've sketched a big black and white picture for us. Let's start filling in the colors. Let's talk stocks. What you've liked over years is ITC, Sun Pharma, Mid-Cap Cement. For 2014, are you still bullish on your old calls, which is ITC, Sun Pharma and Mid-Cap Cement?
I would, on a very big call, I would say we are still optimistic on ITC, Sun Pharma and Mid-Cap Cements. On a very, talking about a very tactical shift in the portfolio construction, we believe that this will be a year where the so-called defensive, the FMCG pack will tend to underperform, and the cyclicals, which are typically the capex stories, the L&Ts of the world, the Crompton, would tend to outperform. So somewhere in the next 3 or 6 months, we will see this tactical shift happening from FMCG stocks to industrial. So as of now, we are recommending investors to go overweight on these cyclicals.
Venkat, what's your favorite from the pharma space?
As I said, we like Sun Pharma, we like Dr. Reddy's. Those 2 stocks we expect will outperform this year.
Venkat, there is no evidence of some kind of an economic turnaround or earnings bottom for any of the cyclicals. But names like Crompton Greaves, Voltas, BHEL, Tata Steel, all of them have appreciated by more than 50 to 100% from the recent low. So what is driving price action in some of these stocks? Hot air, hope, hype?
You have made a very valid point, and that is something which I would say is a worrisome indicator, because if you look at the price charts, it is not that the price have doubled, but if they have doubled over a longer period of time, still there is some justification. But the problem is all the action has happened in the last 1 month or 2 months. So in a very compressed time frame, without any significant, I would say, uptick in the movements, the prices have doubled. So if you ask me, this would be a cause for concern. But the markets never tend to behave in a very structured or a nice or a disciplined manner. There is overshooting on either side. So if you look at this quarter numbers, if you get a surprise, then there will be I would say a steep reaction on the downside also. So maybe that will be a better opportunity, I would say, to get into these stocks rather than chasing these stocks on the way up.
Venkat, what's your sense? Post the cleanup act, do FT and MCX need a revisit?
I think the reason for these stocks to do very well is simply because the franchise is still intact, and there is I would say a quote unquote significant a new management in place. There are chances of a strategic sale or a corporate restructuring. So these are to my opinion are reasons why these stocks have rallied so significantly. As you pointed out, these have been the best performing stocks for the last 3-4 months. So we have to wait and watch and see what further steps are taken before taking a further call on these stocks. More than anything else, I think new management and quote-unquote expectations of corporate restructuring are the key drivers for these.
Venkat, the market run-up from the recent low is quite extraordinary. The index is up more than 15% from the August low. Mid-cap index is up more than 30% from the recent low. For those who are getting this miss the bus feeling, is it a good time for them to invest now? Because markets have corrected for 5 days on the trot now. The euphoria which was there last year seems to be fading away, and good quality stocks are again giving you good entry points.
My opinion is that for the retail investor or for the common investor, it's very difficult to time the market, and it is absolutely one should never get this feeling of left out, because nobody can predict the bottom. And if you step back in time in August, it would have been a very courageous call to go out and buy market when everything was falling all around you. And as you pointed out, we had a dream run since August, and the markets have done extremely well. So our advice to investors is that you should continue, especially retail investors, is to have a disciplined approach to investing, and don't get carried away by either the extreme lows or the extreme highs. So one should have a disciplined approach, do a SIP on a large diversified fund, and as they said, timing the market is more difficult than timing the market. So you spend more time in the market or a longer time frame, you get returns.
Venkat, good chatting with you. Really appreciate you taking the time out and speaking with us.